This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 1, 2026, and this is the After Hours session. Now, let's get into it. The S&P 500 is pushing against a ceiling, but the floor is cracking elsewhere. SPY sits at $746.77, barely a breath away from Friday's high, yet the small-cap Russell 2000 just bounced off a wall at $300.98 for the third time this week. We are witnessing a market split down the middle, one leg straining upward on tech dominance, the other quietly giving way. Let's look at the data. Let's start with the pulse of the room. VIX is sitting at 17.65, down 0.76 points. That feels calm. Does it feel safe? It feels like a trap, and the options market knows it. We are seeing a classic complacency spread. The VIX is suppressed at 17.65 precisely because everyone is betting on the same horse, megacap tech. But look at the breadth. The triple Q is up 1.7%, but the IWM is only up 0.5%. That divergence tells me retail traders are buying the dip in the Russell, thinking it's safe, while smart money is silently reducing delta in the broader market. The low VIX isn't confidence. It's an over-leveraged bet that the status quo will hold until the next earnings report. And when the meta catalyst fades, that complacency flips instantly to panic.
And that flip is imminent at a very specific coordinate. SPY is at $746.77. The June 30 high, the absolute ceiling for this 10-day range, is $748.02. We are talking about a $1.25 gap. On my charts, this is a double top forming on the hourly time frame. Look at the IWM. It hit $300.98 and got rejected hard. That is a structural failure. The market tried to break out of the $300 integer level 3 times in 5 sessions. It couldn't do it. Now, if SPY tries to push through $748.02 without IWM following suit, that is a textbook bull trap. Volume will dry up, and we'll see immediate mean reversion toward that $741 support level, which is essentially last Tuesday's close.
I agree with the structural weakness, but let's look at the fuel, or lack thereof. The technology sector is up 2.76% to $190.52. That is massive outperformance. Where is that money coming from? It's not earnings, it's narrative. Meta is gapping up 6.3% to $598.90. That single name is doing more heavy lifting than the entire industrial sector, which is up a modest 1.35% to $185.23. Here's the problem. Look at the semiconductor subsector. MU is down 5.4%. WDC is down 6.1%. You have a fracture inside the growth trade itself. Software narratives are running hot, but hardware fundamentals are bleeding. You don't get a sustainable bull market on one stock's gap up and 7 other chips falling. That is not alpha, that is noise.
And that noise is hiding the true risk profile. CIPHER mentions the fracture, but he's missing the collateral damage. Look at consumer staples. Consumer staples down 1.54%. Look at the real estate sector. Real estate down 1.98%. Investors are actively dumping safety. They are taking money out of bonds and staples and shoving it into high beta tech because the VIX is low. This is the definition of a peak risk-on environment. When the curve flattens to plus 0.3 pp and you see capitulation in defensives, it means there are no buyers left for anything conservative. Everything is priced for perfection in tech. If Meta misses a beat, or if the 10-year yield ticks up, there is no buffer. The market has no insurance policy anymore.
So we have a narrow rally driven by one stock, structural failures in small caps, and capitulation in defensives. Let's dig deeper into the technology sector dominance. Is this strength justified by the underlying flows, or is it a liquidity illusion?
It is a liquidity illusion. Let's look at the technology sector composition. The plus 2.76% move is not broad-based. It is concentrated in the Magnificent 7 proxy. I'm seeing unusual option activity in the triple Q calls expiring this month, specifically around the $740 strike, a level significantly below the current $736.40 price. But wait, actually, the strikes are higher. The call writing is happening at $750 and $760. Market makers are shorting the upside. They know that at $748.02, the sellers will step in. Meanwhile, look at the WDC drop of 6.1%. That's not a fundamental failure, that's a position unwind. The flow is exiting hardware. The flow is entering software narratives. But software narratives don't pay dividends. They rely on multiple expansion. And with core PCE stuck at 3.41%, that expansion is running out of runway.
CIPHER is describing the why, but I'm telling you where it breaks. The chart doesn't lie about the exhaustion. Triple Q is at $736.40. The 10-day high was $745.45. We are within $9 of the range maximum. Usually when you approach the upper bound of a 10-day range with declining relative strength in the diamonds, which is barely up 0.14%. The path of least resistance is sideways or down. The volume profile shows thinning bids between $736 and $748. There is no liquidity to absorb a sell-off. If SPY touches $748.02 and sees no follow-through from the mid-caps, the algorithmic exit buttons trigger simultaneously. We're looking at a liquidity void above $748.
And the sentiment is screaming that nobody believes it will break through. The put/call ratio for the triple Q has spiked 15% in the last hour. Traders are buying puts as insurance against the $748 rejection. They aren't buying puts because they think we're crashing today. They're buying them because they think the breakout will fail. Compare that to the SPY P/C ratio, which is flat. The market is hedging the tech bubble while ignoring the broader index. That is a mismatch. The crowd is preparing for a sell the news event on the tech breakout. When that happens, the VIX will jump from 17.65 toward that 20.72 level instantly. The speed of the drop will be determined by how many people are caught long without hedges.
Exactly, and here is the kicker, the yield curve. The 10-year 2-year spread is plus 0.3 pp. It's positive, yes, but it's flat. A flat curve hates banks and industrials, yet we are seeing the industrial sector up 1.35%. How? Because the market is pretending the cycle hasn't turned. But look at the materials sector, materials, up only 0.34%. Look at the energy sector, energy, down 0.88%. The industrial backbone of the economy is weak. You are building a skyscraper, the technology sector, on a swamp weak breadth/yields. When the wind picks up, and remember, we have earnings reports like GIS and AA hitting tomorrow, the foundation cracks. The VIX is low now because the market is asleep. It wakes up fast.
Let's pivot to the individual movers causing this divergence. Meta is the engine, but MU and WDC are the casualties. What is the story here?
It's a sector rotation within the rotation. Meta is benefiting from the infrastructure narrative, AI capex spending. The plus 6.3% gap up is supported by above-average volume, meaning institutional buyers are stepping in, not just speculators. However, MU is down 5.4%. Why? Because memory chip cycles are distinct from software demand. Buyers are exiting hardware exposure and moving cash into the application layer represented by Meta. This is a quality trade within the tech sector. They are shedding the cyclical hardware, MU, WDC, and keeping the dominant platform, Meta. So, don't mistake MU's drop for a tech crash. It's a rebalancing act, but it leaves the broader semi-index, SOX equivalent, looking ugly, which drags down the triple Q's ability to sustain a breakout.
Technically, MU dropping 5.4% while triple Q rises 1.7% is a bearish divergence signal. The leader is rising, the laggard is tanking, and the index is masking the loss. On the MU chart, we've broken below the 20-day EMI. That's a short-term sell signal. But more importantly, look at WDC, down 6.1%. It's trading below $70. The volume on the down days is heavier than the up days. That is distribution. Smart money is leaving these names. If you are holding MU or WDC, the technical structure is broken. You are fighting the tape. The tape says sell hardware, buy software, until MU finds support above $90, and frankly, it looks far from there. That drag on the triple Q is real.
And that brings me back to the concentration risk. You have a scenario where the entire triple Q index's performance depends on Meta holding its ground. If Meta opens tomorrow and gaps down even 2%, the technology sector drops. The triple Q drops. And suddenly, you have that bull trap grid talked about, but with accelerated velocity. The risk isn't just a slow grind lower. It's a flash crash in the tech sector if the narrative breaks. And with GLS reporting earnings tonight, the scrutiny on AI monetization is going to be intense. Any hesitation in guidance gets punished. We saw it with NVDA last year. We might see it again with Meta.
Let's address the IWM failure. The Russell 2000 closed at $300.45, having failed to break $300.98. Is this a minor blip or a major warning?
It is a major warning. 3 failed tests of the same level, $300.98, is not noise, it is resistance. The market has tried 3 times to push through the 300 handle. It failed each time. The closing price of $300.45 is right at the edge of the 10-day low of $288.93. We are squeezing tight, typically. When price action consolidates in the lower half of its range while the S&P 500 makes new highs, it indicates a decoupling. The small caps are telling us they don't believe in the rally. If IWM closes below $297.44, yesterday's low, we enter freefall territory toward $290. That is a 3% move in a week. That is painful for leverage funds. The refusal to break $301 is the strongest bearish signal in the entire equity complex today.
From a flow perspective, I'm seeing net redemptions from small-cap ETFs over the last 48 hours. Institutional investors are de-risking. They are moving cash from illiquid small caps into the highly liquid mega caps, the technology sector / triple Q. This flight to quality is understandable in a high-inflation environment, CPI 4.17%, but it starves the small caps of oxygen. Without inflows, the technical support at $301 is just paper. It looks solid until it isn't. Once the algorithmic selling starts, there are no buyers at $300. We could see a slide to $290 very quickly if the SPY corrects.
And that is the contagion risk. Small caps lead indicators often. If IWM breaks below $300, it triggers stop losses on thousands of speculative names. Those stops generate sells, which depresses the broader market sentiment, which hits the SPY. It's a chain reaction. The fact that the VIX is still low at 17.65 gives everyone a false sense of security to ignore this breakdown. By the time the VIX spikes, the damage to the small cap index could already be 5–7%. Watch the $300 level like a hawk. If we close below it on Monday, the soft landing narrative dies.
We have the VIX low, IWM weak, the technology sector strong but narrow, and individual names like Meta carrying the weight. Apex, tie this together. What is the state of the market?
The market is in a fragile equilibrium. Grid has mapped the $748.02 resistance on the SPY and the $301 rejection on the IWM. CIPHER has shown that the technology sector rally is driven by a single narrative, Meta, while hardware fundamentals, MU/WDC, deteriorate. Pulse has highlighted that the low VIX of 17.65 is masking a massive divergence in sentiment between large and small caps. The synthesis is simple. The market is long only on the big boys and short on everything else. As long as Meta holds, the SPY can hover near $748. But the lack of breadth, from IWM's failure to consumer staples' collapse, means there is no foundation. We are walking a tightrope without a net. The risk/reward is heavily skewed to the downside for anyone chasing the triple Q breakout.
So, what do we watch overnight? We have Meta earnings tomorrow morning. We have GIS reporting. And we have the IWM holding its breath at $300. If Meta sustains the $598 level, the SPY might punch through $748 temporarily. If it falters, the whole house of cards shakes. Stay alert. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.